Chairman Conway, Ranking Member Peterson, and members of the committee, thank you for the opportunity to be here this morning. I'm Amber Baldet, co-founder and CEO of Clovyr, a company building tools that make it easier to build decentralized applications on top of both publicly accessible blockchain networks and access-controlled distributed ledgers. Previously, I led the blockchain program at JP Morgan, though I'd like to note that my comments today do not represent my former employer. I also currently sit on the board of the Zcash Foundation, a nonprofit organization seeking to advance the state of the art for privacy technology as applied to internet infrastructure and privacy-preserving cryptocurrencies. These are a variety of disparate hats, all of which lead me to the same message. My commentary today concerns the importance of a cautious and thoughtful regulatory approach to innovative technologies, even and especially those that might disrupt business as usual or add to the complexity of regulating the internet as both critical infrastructure and a shared public good. We must determine how to balance the enormous potential value of this technology with the need for consumer protections and national security, and how to achieve this while respecting human and constitutionally protected rights. So far, money seems to be the killer app for blockchain. Much as the early internet's killer app, email, continues to be a cornerstone for how we communicate online, peer-to-peer payments will likely grow into and persist as a ubiquitous part of our personal and professional daily lives. In fact, the ability to spend, trade, rent, or license other sorts of unique digital bearer assets could be applicable to many things we own. Mortgages, securities, collectibles, intellectual property rights, personal data, etc. Imagining this mature, interconnected global ecosystem of such markets feels like standing in the 90s and imagining Netflix streaming on your phone. And yet, my concern is not the speed with which we reach that end state. It's the choices that we make along the way, which stand to be as hotly contested and impactful as net neutrality, the DMCA, FOSTA SESTA, or the on-again, off-again discussion of state-mandated weak cryptography continues to be. While we struggle to overlay existing regulatory frameworks onto new technology that is useful precisely for its fluidity, other areas of the world are embracing that ambiguity and learning by doing. In Afghanistan, for example, Code to Inspire helps train young women for technical careers and pays them in Bitcoin, which they can use in local shops as well as global marketplaces. In a place where women's banking and even physical agency is limited, financial autonomy and digital inclusion is a powerful force for equality and democracy. In some African countries and places with less legacy financial infrastructure, companies are using crypto assets to enable farmers to properly track and register their commodities and increase their bargaining power in downstream market pricing. Not only can end consumers tip their farmer in support of fair and sustainable working conditions, but every other factory or wholesale retailer along the way can make more informed decisions about the provenance of inputs to their products. In the United States, Square, whose business strategy is already based on disrupting traditional payments processors, has added the ability to buy, sell, and transfer Bitcoin into its mobile app, and there are many products targeting cryptocurrency investors and early adopters. There's also several more experimental projects that are interesting. For example, using economic incentives to battle fake news, cryptocurrency micropayments as an alternative business model to data-hungry online advertising, and fluid marketplaces for unused disk space on your home computer as a disruptive force to centralized cloud storage. These projects, all launched as initial coin offerings, ICOs, either on a new single-purpose blockchain network or as a token on top of an existing network like Ethereum, are often compared to the internet startup boom of the 90s. The ability to, quote-unquote, code oneself out of business is a novel property of these decentralized blockchain applications, but most experiments today invoke a variety of human-controlled workflow checkpoints and escape hatches to allow intervention if necessary. Along with understanding who controls access to the network and who can modify the rules of the system, identifying who controls these escape hatches might be helpful in sorting tokens into various asset classes once a sensible taxonomy has been established. As a counterpoint, blockchain is not the answer to every problem. For example, I recommend extreme caution with exploration of blockchain-based e-voting. Ensuring one person, one vote while keeping ballot selections private is an incredibly complex computer science and human coordination problem that we are not ready to tackle yet. Internationally, it's no surprise that some of the central banks most aggressively investigating cryptocurrency as an alternative or enhancement to their existing currencies are in Venezuela, Russia, and China. Going forward, as there is inevitably more discussion of the potential for a digital dollar, I encourage strongly encrypted, privacy-preserving design choices coupled with opt-in selective disclosure, as opposed to options like mandatory cryptographic backdoors or golden keys, which could make the US financial system a very attractive target for nation-state-sponsored cyber attacks and hackers. As that conversation matures, we must clarify how FinCEN, OFAC, and other relevant rules can be applied, modified, or interpreted to balance many competing interests. So in conclusion, and hopefully if this committee's guidance is simply a strong commitment to non-interventionism, safe harbors for innovators, and work towards resolution of the patchwork fabric of state laws, the time it takes to come to such a commitment may have the unfortunate effect of eroding America's early mover advantage in technical innovation and entrepreneurialism. Thank you.
Thank you, Ms. Baldet. Mr. Cooper?
Thank you, Chairman Conway and Ranking Member Peterson, for the opportunity to be here today to talk about this very important new technology. My name is Scott Cooper. I'm the managing partner for a firm called AH Capital Management, which manages about $7 billion worth of venture capital assets, and very recently also for a group called CNK Capital Management, which is a $300 million registered investment advisor fund focused exclusively on investing in crypto-related assets. I'd like to spend my time today to focus on why we believe as investors that crypto technologies make a very compelling investment opportunity, particularly for members of the venture capital community. And I want to start with a definition that's different from the definition I think that we often hear about. So if you focus on a lot of the public narrative today around crypto technologies, there are two kind of dominating narratives. One is certainly around Bitcoin and price fluctuations and volatilities, which we heard certainly from the ranking member today as well as what are called initial coin offerings, ICOs, for capital fundraising. As investors, though, we're interested in the broader ecosystem, and we use the term crypto networks to describe what we think about as that ecosystem. Very specifically, crypto networks for us means a new way to build digital services. And by digital services, we mean any internet application that obviously may exist today, so ride-sharing applications, social media applications, and probably a whole host of things, of course, that we haven't even thought about. But where those digital services are owned and operated by a community of network participants rather than by a centralized corporation. Now, I realize at first blush that when you think about community ownership and management of an asset, that may seem odd. But in fact, if you look at the technology industry, there's actually significant precedent for the existence and the success of community-based networks in the development of a significant portion of technology. First is what is known as the open source software movement. This started back in 1983, actually, at MIT by a professor named Richard Stallman. And at the time, it was a very, very radical notion. The idea was that a community of developers would publish and then freely offer their software to others who could modify that software, who could incorporate it into various other projects. It was really, in many respects, a very liberal movement around opening up and reducing kind of copyright initiatives in software. If you fast forward to today, though, open source is the predominant method of software development and software utilization today in the world. For any data center you go to, which is obviously where major corporations run their internet applications, Linux, which is a major operating system, is by far the dominant operating system in play. And for all of you who, like myself, who walk around with your cell phones all day long, the vast majority of components in your cell phones are what are called Android and essentially open source software. So the history of open source software, I think, is relevant for how we think about the potential for what Bitcoin and crypto networks can be. The second important historical analogy is around what we call open protocols, which really form the foundation of the modern internet that we all use today. An example of this is something called SMTP, which is the protocol that we all use for email transmission. It's an open protocol. It was governed in many cases by open communities, by networks, by academics, and in many cases with government funding. And many people built applications on top of these open networks precisely because they knew that the nature of that protocol would not change. They could rely on the steadiness and the consistency of that protocol on which to build applications. So if we look at technology, open protocols that are well-developed and well-maintained can become the building blocks on which massive customer utility and economic growth can be built. It's also the case, however, if you look at the startup world, that many startup companies have failed by relying on what we call platform risk, which is building on other platforms that are governed by centralized corporations and then finding that the rules of the road change over time, and that really does significantly handicap their efforts. As a result of this, what we now see in our business is many developers are hesitant to take on this platform risk and are instead looking at things like crypto networks as a new and innovative way for developers to create new digital services without the attendant risk that comes from depending upon centralized platforms. In many ways, crypto networks borrow from the nearly 50 years of history in the technology industry, which shows that communities of developers can share their work openly and properly govern a network without centralized authority. But crypto networks also introduce a very powerful economic incentive that didn't exist in these prior generations, the presence of what we call a token, which creates a direct financial incentives for members of the communities to in fact develop and govern the networks appropriately. The token really, in a sense, is the glue that binds the various players in the ecosystem and provides the appropriate economic incentives for all market participants. Understandably so, this creates a whole new set of challenges for regulators. Consistent with recent statements that we've heard from the Director of Corporate Finance at the SEC, we believe that the regulatory nature of crypto networks varies with the stage of development of a particular project. Briefly, when a centralized sponsor is seeking to raise capital from investors prior to the functional development of the network, this is probably what is known as an investment contract and therefore properly regulated as a security. However, the nature of the tokens that are delivered on that contract can ultimately be regulated as commodities once the fulfillment of that investment contract has occurred. As stated by the CFTC, some tokens are not securities once the network is functional, and in particular in cases where the network is decentralized from an ownership perspective, we believe the nature of the tokens looks more like commodities than securities, and therefore probably rightly should be governed by the CFTC. This is precisely because there's no centralized sponsor on which the efforts of the value of the token are largely dependent. Instead, the tokens have value based upon the utility of the service to participants. This actually looks much more like the way commodities trade. In conclusion, the U.S. has long enjoyed the fruits of innovation in the form of economic growth, job growth, and consumer utility stemming from many of the great technology companies of our time, and we believe that crypto networks present a new and exciting opportunity for us to continue on that trajectory. Doing so, however, will require that we develop a regulatory framework that encourages risk-taking and capital formation, provides clarity and certainty to market participants, and of course protects individual investors and the integrity of the markets. Thank you for the opportunity to be here today.
Thank you, Mr. Cooper. Mr. Gorfine, 5 minutes.
Thank you, Chairman Conaway, Ranking Member Peterson, and members of the committee for the opportunity to testify before you today. I am Chief Innovation Officer and Director of Lab CFTC at the U.S. Commodity Futures Trading Commission. The testimony presented here reflects my own views and does not necessarily reflect the opinions or the views of the Chairman or the Commission. In May of last year, Chairman Giancarlo announced with bipartisan Commission support the launch of Lab CFTC, the agency's effort to help create a model for regulatory engagement and modernization in light of the ongoing digitization of our markets. Its mission is to facilitate market-enhancing innovation, inform policy, and ensure that we have the technological and regulatory tools and understanding to keep pace with inevitable change. The building blocks of our effort are engagement, testing and experimentation, and education. Shifting to the primary topic of today's hearing, we are interested both in private or permission-distributed ledger technologies that can improve market infrastructure and in public blockchains that require the use of a virtual currency. Developments across this spectrum have society rethinking the nature of money, how people transact, and how we can more efficiently engage in regulatory, economic, and market activity. With respect to public blockchains, proponents note that they unlock digital scarcity, enable efficient transfer of ownership, and power the execution of applications, and all of this can be done without the need for a trusted central intermediary that was traditionally needed to verify that each party has and does what it promises. Many, however, appropriately worry that virtual currencies and tokens may be used for illegal activities and are prone to fraud, manias, and bubbles driven by potential misunderstandings and myths regarding their scalability, utility, and intrinsic value. With recent hype around this space, there has also been a proliferation of ICOs, which may be intended to raise capital for a venture and may bear the hallmarks of a securities offering. Our colleagues at the SEC have been thoughtfully addressing related challenges and providing additional clarity to the marketplace. And from the CFTC's perspective, given the potential to tokenize a broad range of economic assets, it is important to remind the public that digital assets can also be commodities or derivatives, depending on their terms and how they are structured. Given the potential and the challenges of this space, Chairman Giancarlo has made clear that the proper response by regulators is not to dismiss the entire movement as misguided or foolish, but rather to take the time to learn, facilitate the promise, and guard against risks and bad actors. As part of this effort, Lab CFTC published its first FinTech primer on the topic of virtual currencies in October 2017. The primer explains that the agency determined in 2015 that certain virtual currencies, such as Bitcoin, are commodities and therefore implicate our jurisdiction. The CFTC has regulatory oversight authority over futures and swaps markets based on commodities, and then has anti-fraud and manipulation enforcement authority over these and the underlying commodity markets. It is important to note, however, that we do not have oversight authority over these underlying markets. Additional details regarding CFTC oversight of crypto-related markets and enforcement and education efforts since the self-certification of Bitcoin futures in December 2017 can be found in my written testimony. Moving forward, one thing is certain. None of us are able to predict exactly where this innovation is heading. It is accordingly incumbent upon us as a 21st century regulator to continue studying, learning, and keeping pace with change. We look forward to ongoing close collaboration with our regulatory peers, including through the FSOC Digital Asset Working Group. We all have the shared goal to educate market participants, target bad actors, and ensure an efficient and effective regulatory framework. We are also focused on bringing clarity and certainty to the market, but need to be sure that we are thoughtful in our approach and do not steer or impede the development of this area of innovation. While some may seek the immediate establishment of bright lines, the reality is that hasty regulatory pronouncements are likely to miss the mark, have unintended consequences, or fail to capture important nuance regarding the structure of new products. In the late 1990s, during the early days of the Internet, senior government policy advisor Ira Magaziner made the following observation, that given, quote, the breakneck speed of change in technology, government attempts to regulate are likely to be outmoded by the time they are finally enacted, end quote. Given this dynamic, the government largely avoided a prescriptive approach in favor of principles focused on educating and empowering law enforcement and allowed this area of innovation time and space to develop, all while maintaining the ability and careful vigilance to act to ensure market integrity. This approach generally seems like the right one when dealing with new technologies, which are largely agnostic as to how they are used. The role of the regulator is to facilitate use of new technologies that can benefit markets and the public more broadly, while deterring and pursuing those who seek to use technology to do harm. Thank you, and I'm happy to answer any questions you may have.
Thank you, Mr. Gorfine. Mr. Gensler, 5 minutes.
Thank you. Good morning, Chairman Conaway, Ranking Member Peterson. My condolences on your dad's passing. It's good to be with you all here today. I think I've testified in front of you a dozen or 2 dozen times in some previous capacities. But since I was last with you, I took on a new role at MIT where I am engaged, yes, in researching, teaching, lecturing, and advising on digital currency and blockchain technology. Now, I say that, but for those who don't know, because some are new, I also chaired the Commodity Futures Trading Commission for 4 or 5 years. And before that, long ago, I was 18 years at Goldman Sachs. So I bring from my years in finance, my years in public policy, and now, I guess as an academic, some perspective of what I've learned. And with the chair's permission, one thing I've learned as an academic is to ask the audience a little bit about their engagement in Bitcoin. So again, with the chair's permission, if I could just ask, how many members of this committee have invested in cryptocurrencies? And I'm going to ask the audience, too. So we've got
Just show of hands.
one in the audience.
All right, Bob.
Show of hands.
Several in the audience.
Yeah, we've got about half the audience. That's an interesting split. There we go. I would say the other thing that splits the community in my discussions usually is, this is not a community that splits normally like right and left, Republican, Democrat. This is a community that splits more about Bitcoin maximalist and Bitcoin pessimist, or skeptics on one end. And by the way, some of those skeptics and pessimists are Republican and some are Democrats. Some are Nobel laureates, some are in finance, whether it's Jamie Dimon or Warren Buffett. And then some of the maximalists can be venture capitalists like at Andreessen Horowitz and elsewhere. So it's interesting, the split in the community. I'm probably a little bit center maximalist, if I can say that. You know, I am an optimist on the underlying technology. You'll also hear some people say, well, not that Bitcoin, but the blockchain technology is good, and they kind of split their views that way. So again, what have I learned? Blockchain technology, I believe, has a real potential to transform the world of finance because it is about money, it's about moving value on the internet. This new technology could lower costs and risk in the financial sector. Second, to reach its potential, I feel strongly that, and for public confidence, to reach its potential, we need to bring it inside the world that we know, the long-held public policy frameworks. Now, what are those frameworks? Congress has a role to play to tinker about these frameworks, but I'm just saying, what are our historical frameworks about technology and finance? We guard against illicit activity like tax evasion or money laundering. We ensure for financial stability, and we protect investors and consumers. Those are the three big ones. We protect against illicit activity, we ensure for financial stability, and we protect investors. Everything else is debatable, and we need to adjust the details underneath that. Third, the SEC and CFTC do have a role to play. Both of them have roles to play. They've released numerous notices and enforcement actions and so forth. However, there's a lot of non-compliance. I mean, there are thousands of entrepreneurs out there that probably right now are not complying with SEC guidance. And there are fewer that are not complying with CFTC guidance, but that's just because the CFTC doesn't have oversight of this thing called the initial coin offering market, and that's where there's a lot going on. And this thing's going large and big. It's about a $250 billion market. $250 billion is getting some size. I mean, the overall capital markets in the world are about 250 trillion or 300 trillion, so it's not threatening that. But thousands of ICOs have been raised, $20 billion of capital formation. I'm here to say nearly all of them, I don't know if it's 98% or 97%, but nearly all of them are probably securities under our securities laws because they're being offered in a pre-functional time. This ICO market's rife with scams and frauds. Fourth, bad actors have figured out how to use this new currency. Sometimes it's state actors. We learned last Friday it was the alleged, I should say, but the alleged 12 Russian spies. Venezuela tries to raise it off of their oil and outrun U.S. sanctions policy. Fifth, while federal agencies are engaged, current laws apply to this activity. There are gaps. So if I can mention a few of the gaps. First, I think that there's gaps around the crypto exchanges themselves, either where you can buy and sell. Why? Because they're being right now regulated through state money transmission laws. This approach, regulating them like Western Union or MoneyGram, is just not satisfactory because crypto activity is more complex and it's harder to trace, and it doesn't build on top of the traditional banking system. It's built on something that we can't see that's out there in other countries, like in China and Russia. So second, the crypto exchanges lack brokered access. They don't have brokers. So there's no brokers, by the way, sending 1099-Bs, and my detailed testimony says, you know, maybe the IRS should do something about that so you can just have reporting of the gains. Third, the issuers of securities, the crypto space, are only slowly coming into the SEC remit. I think this is going to take 2, 3, 4 years before the SEC really cleans up the space. And so there's going to be a lot of call, can they go faster? Can we do it right? But it's going to take some time. Fourth, crypto derivatives are being handled by the CFTC. I think they're doing it well, but there's two things that worry me about the technology. And one is that the unregulated underlying crypto cash market is a mess. So the corn and wheat markets that you oversee, the gold and the oil markets, we have a lot of history. We have some confidence about that. And then the CFTC can do their job layering over those underlying commodities. The CFTC is regulating derivatives, but they're referencing an underlying market where it's just, at best, the Wild West, and at worst, it's pretty bad. So about that underlying market, the CFTC has general anti-fraud and anti-manipulation authorities with regard to it. But I think the Congress will be debating it. Probably not in this Congress, but I suspect in the next session, the next Congress, you all will be debating, should you give the CFTC additional authority, or maybe some other agency, maybe it would be the SEC, somebody else. But I think the CFTC, to have additional authorities about that underlying what I would call cash crypto market, it's 70% of the market. The SEC has securities. The CFTC had derivatives. I think you'll want to debate whether to do something about the underlying market. And lastly, I think you'll need to give them resources along with your friends over at the Appropriations Committee, because I think these agencies will need that. Thank you.
All right. Thanks, Mr. Ginsler. Mr. Ness, 5 minutes.
Thank you all for inviting me to testify this morning. I certainly agree with everybody that's gone before me that this technology does have the potential to be transformative. One of the questions I get asked a lot is, why don't we just call these things securities? We have securities regulations. We could create a scenario where these things get registered and then become, quote unquote, freely tradable. So why not just call them securities, deal with the existing laws? And I think the problem with that is they exhibit some characteristics of securities during certain phases and not in others. And especially when we get to full functionality, when it's a truly completed product that is being sold, the intention of that product is to be used in a network. And that really can't happen, at least not at the speed of software, which is really the fundamental principle here behind these decentralized protocols, is to allow for value transfers truly at the speed of software. You can't do that if everybody's got to be a broker-dealer and all the intermediaries have to interact in a way that that would be appropriate for securities. So we need to come up with a fairly novel and pragmatic approach to dealing with the fact that there needs to be some investor protections, particularly in the early stages, while the thing is a PowerPoint deck and an idea in somebody's mind. But find ways to create some clarity around how and when it goes from being sold as a security to being sold as a commodity. And that is a very important imperative right now because we are seeing so much activity, frankly. And the threat of sort of people going offshore for lack of clarity is a very real one. I will say, in my 25 years in Silicon Valley, I have not seen circumstances where you go to a meetup in places like, Palo Alto or even San Jose, and you see regulators from Zug, Switzerland, and Singapore, and Hong Kong, and Bermuda, and so to avoid any kind of race to the bottom, I do think that there's a serious imperative about getting something done before we have a situation where we're trying to entice people back into the country, because then the standards would really have to be lowered to do that. So I think we have an opportunity now if we get ahead of the true flight, but that's an important idea around why we need some of the bright lines. To that end, I did in some of my written testimony include some materials and a proposed regulatory framework that both talk about what the existing laws say and how the existing laws treat these so-called utility tokens. And there's sort of a 50-page memo on how the existing laws work. To avoid having to go through that 50-page memo type analysis with each and every one of these, I think the bright lines are really what's necessary. So there's a regulatory framework that we've been thinking a lot about that would create that set of bright lines that would enable the regulators and the companies going out there to really know how to sort the good ones from the bad ones. And I do think that starts with kind of this test around Howey and the investment contract analysis for regulating securities as securities in the primary offering if they're being sold sort of pre-functional, before they're fully functional. But coming up with ways to say that once they are fully functional, how do we let them now trade as commodities effectively? And the trading is important because, as I said, this is the movement of value. To have value, it needs a price. And the markets really are a necessary part of this. So the fact that there are secondary markets is a key part of this. They need to be able to trade in those markets to establish price. They also need to be able to be used in their networks as non-securities. And so we need to come up with ways to say, when they're being sold to investors as investments, let's treat them like securities. When they're being used in the network or they're being traded in the secondary markets, let's call them commodities. Thank you.
Well, thank you, Mr. Ness. The chair will remind members that they'll be recognized for questioning in the order of seniority for members who were here at the start of the hearing. After that, members will be recognized in the order of arrival. I appreciate my colleagues' understanding, and I'll recognize myself for 5 minutes. Mr. Ness, I agree with you that if we don't get this right and we flush the innovators offshore into other countries, that getting them back is a lot more difficult. So hopefully, at least this start of the process with this hearing, that we can get to an answer that doesn't do that. Ms. Baldet and Mr. Cooper, you each noted that tokens and crypto networks have the potential to create next-generation open internet protocols. Can you flesh that out a little bit for the layman and myself that understand the words, but if you could tell us what those actually mean, it'd be a little helpful.
Sure, thank you. So when we say open, open means a couple things. In this case, we mostly mean open access when we say public blockchains, which means that anyone can join the network. It has to do with the degree of gatekeeping, which is not necessarily an all or nothing kind of a decision. But we can, if we start thinking of public blockchains as being more like a public commons, it's a lot more like the internet, wherein you have a lot of choice as how you access that sort of network. We also usually mean open source, as Mr. Cooper mentioned, so that we're allowing auditing of that code, which increases trust of the code, and most of the core technology that powers the backbone of the internet is open source.